significantly, still there are certain risks that needs to be monitored. New commodity price spikes from the geographical shocks, supply disruptions, and the persistent underlying inflation could prolong the tight monetary conditions. Against this backdrop, the outlook for the domestic activity is brightening on account of the sustained buoyancy in services, consumer and business optimism, public spending on infrastructure, and underlying strength of the financial sector's balance sheet. Consumer confidence has improved with uptake in most of the macroeconomic conditions. Yet, the Union government has built an infrastructure at a historically unprecedented pace, and it has taken the overall public sector capital investment from about 5.6 trillion in financial year 2015 to almost 18 trillion, which is now projected for the year financial year 25 as per the budget estimates, which is almost a jump of 3.3 times. Gross tax to GDP ratio in financial year 25 is projected to touch 11.7%, the highest in 16 years. GST monthly threshold has moved up to 1.64 trillion. CPI inflation is expected to moderate in coming months. On the external front, the current account deficit is modest, with foreign exchange reserves providing a strong buffer. IMF has recently updated India's GDP growth outlook for the year 2024 to 6.7% from 6.3% earlier, underpinning the growth potential of the Indian economy. While recognizing global risk and the volatility in the financial markets that they may entail, the real GDP is expected to grow at 7.3% in financial year 24. Interim budget has estimated nominal GDP growth of 10.5% in the financial year 25. On the banking front, deposit growth has rebounded, but sustained credit growth momentum has increased the wedge between deposit and credit growth. As on 12th of January, all scheduled commercial bank credit grew by 20.3% as against 16% last year, and deposit by 13.1% as against 10.6% last year. Latest credit growth numbers reveal a sustained pickup across agriculture, MSME, and services. Now I come to the bank's performance. Coming to the bank's performance, once again, we have delivered the stellar numbers. Our net profit in 9 months of the financial year 24 stands at 40,378 crore, which has seen an increase of 20.40% over the 9 months of financial year 23. This is despite the fact that we have provided for the wage revision of 12,718 crore during the current financial year, as per the bipartite settlement, wage settlement at 17% wage hike. Further, I am happy to share that our net profit for quarter 3 of the financial year 24, which stands at 9,164 crore, is after absorbing the additional liability to the tune of 7,100 crore on account of the anomaly of the pension which used to persist ever since 2002 onwards. There was a set of employees in the bank who were entitled for a pension of 40%, and there were a set of employees who were entitled for a pension of 50%. There was the matter was pending before the court of law, and now there is a settlement almost in offing. We have got the approvals from the GOI as well as from the RBI, but we are still awaiting the formal notification. But nevertheless, since we were in a position to have a very clear visibility of this liability, we have provided for this additional provision of 5,400 crore on account of this increase in pension for all the employees. And secondly, there was another obligation on account of the dearness relief neutralization for the pre-2002 retirees, and this obligation was to the tune of 1,700. It's a one-time obligation which was required to be provided for, and I'm happy that we could provide for all this, and despite that we are in a position to generate the quarter 3 profit numbers of 9,164 crores. In fact, if you really look at it, we have accelerated our provision for the wage revision, and also we have provided for this one-time obligation also, and our net result is post accounting for all these one-time items. The return on asset of the bank is at 0.94% for 9 months of financial year 24, and it has improved by 7 basis points over 9 months of financial year 23. The ROE for 9 months of 24 stands at 19.47%, and it has improved by 88 basis points over 9 months of 23 last year. We have been consistently delivering ROE in excess of 15% since last 6 quarters. Our aspiration from our current position of strength is to sustainably deliver a ROE of more than 15% through business cycles. The cost to income ratio of the bank stands at 57.35%, but that is after including the impact of wage revision provisions and excluding the impact of one-time exceptional item of pension liabilities and dearness relief neutralization. Overheads have been under control and have shown a decline of 3.10% sequentially. We are mindful of our liability portfolio as it provides a stable stream of resources for us. We continuously monitor the concentration of our deposit profile daily, ensuring that dependency on the wholesale funding is contained within the prescribed levels. The differential rate of deposit and CDs are just around 13% of the total deposit. We retain reasonable reserve resources in the form of liquid assets over and above the CRR SLR requirement to meet the future contingent demands and broad-basing the deposit mix. Unencumbered excess SLR was about 4 trillion as on 31st of December 23, and the liquidity coverage ratio stands at 131% as on 31st of December 23. That is much above the regulatory benchmark. I'm happy to highlight that the credit growth has been robust across all the segments. Our retail personal book now stands at 13 trillion and is growing at 15% YOY with an industry-leading asset quality. The growth in agri, SME and corporate segment has been healthy at 18%, 19% and 11% respectively. I'm glad to share the progress we are making in digital banking. 59% of our savings bank accounts were opened through YONO in the 9 months of this financial year 24. We are also leveraging analytics with significant business of rupees 95,000 crore being sourced through analytical leads, showing a growth of almost 37% on a YOY basis. With regard to asset quality, our gross NPA ratio has improved by 72 basis points YOY and now stands at 2.42% as at December 23 and continues to be at its lowest level in more than 10 years. Our net NPA ratio has also improved by 13 basis points and stands at 0.64%. Slippage ratio for 9 months of financial year 24 has improved by 5 basis points YOY and now stands at 0.67%. The consistently improving asset quality is also reflected in our credit cost, which now stands at 0.25% and has improved 12 basis points on a YOY basis. We have well provided for our loan book with PCR, including OCA, standing at 91.49% and PCR for quarter 3 of financial year 24 without OCA stands at 74.17%. While we are glad about the outcomes in the current quarter, we are also conscious of the areas for further improvement. On the liability side, we continue to focus on increasing our share in the current account while maintaining our leadership position in savings deposits. Our CET1 ratio, after considering the plowback of profit for the 9 months of 24, is at 10.38%. Additionally, the current ROE profile of the bank is above the credit growth trends, which will lead to CET1 incremental accretion. However, the bank is open to raising equity capital if the growth trends so warrants. Our subsidiaries are also consistently performing well and continue to create significant value for all the stakeholders and most importantly for our customers. Concluding my opening remarks, I want to thank all of you for your support to the bank. The bank, while pursuing its own progress, contributes to the progress of the economy and also for the broader ecosystem. We remain committed to reward your trust in us with superior sustainable returns over the long term. My team and I are now open for the questions from all of you. Thank you.
Thank you very much, sir. Now we'll move to the question answer session with the media. To ensure seamless flow of the session, we will move from this side to that end. allowing everyone an equal chance to ask a question. We request you to please follow the format and restrict yourself to 2 questions at a time, focused on the bank results. If time permits, we may repeat the circuit for additional questions. I now request Mr. Ben from PTI to please start.
Yeah.
From a sector point of view, and what is your outlook on credit cost and on the reported price?
So as far as the slippages are concerned, we have seen on a YOY basis there is a reduction in the slippages, and of course for the quarter it might look to be little on the higher side, but out of that also we have pulled back almost about 900 crores. There is one particular SME account which is having a challenge in terms of its financial weakness. So we will be looking at it in terms of the restructuring. So that is the only major item. As far as the slippages in the retail, SME and agri are concerned, agri normally there is a phenomena which is more seasonal in nature. We always see that in the month of November, December, but we are quite hopeful that we should be in a position to pull back those slippages also. I think as far as slippages are concerned, that should not be a matter of concern. On a YOY basis, we have actually seen the reduction in slippages. As far as the outlook on the credit is concerned, what we are observing is that the credit growth has been very broad-based. We have seen about 19% growth in our SME book, 18% growth in our agri book, and almost about 15-16% growth in retail, and 11% growth in our 10.67 or around 11% growth in the corporate book. And also we have seen a decent growth, almost 13% in our international book. So we are seeing a very healthy trend as far as the credit growth is concerned, and we are quite hopeful that it should continue going forward as well.
Thank you, Ben. We take the next question from Mimansa from NDTV Profit.
Hello, sir. So my first question is that have you liquidated any of your SLR holdings in this quarter to boost the credit growth?
No, nothing like that. Our liquidity coverage ratio is even 131% even now. So we do enter into some kind of a trade on an ongoing basis, but if at all on a net basis, we would have bought some more than 20,000 crore worth of securities, yeah, in this quarter. So that's not a challenge. And also our credit deposit ratio for the month of December was 66%. So we don't have any challenge. We are quite liquid to support the growth of the economy, let me assure you. Yeah.
So what is the mix of EBLR and MCLR loans in the loan book?
We would have almost about 64% of our loan book is in terms of MCLR and EBLR, and the breakup is in terms of MCLR it is about 38%, 37.6%, and EBLR is 27%.
So MCLR is higher.
Yeah.
Why did the bank not decide to increase the lending rate because the NII growth is not too high this quarter?
MCLR is something which is a formula driven. So when when it is actually a derivative of the formula. So whatever that prescribes, we have gone for that.
Thank you, Mimansa. The next question is from Ram Kumar from the Hindu Business Line.
Just want to understand, is there something that is weighing your non-interest income growth actually? It's almost flat actually.
See, this is also attributed to the kind of market situation. We have various components in the non-interest income, and when it comes to government commission, yes, of course, it is almost flat and it is rather on a downward trajectory, marginally. But when it comes to our foreign exchange income, we are on the upside. And also, we are also having a situation where in this particular quarter, which has just gone by, this was a festival season, and in the festival season, normally to attract the best quality business, we have got a situation where we give some kind of a concession on the loan processing, particularly in the retail sector. So that is the reason. But there is nothing structural as such. Structurally, I think we are moving in the right direction. And when it comes to our cross-sell, even that is also going well. And we don't envisage any major challenge eventually. And also, there is always some kind of a phenomena. There are some, in one quarter there will be locker rent which will come in. In the subsequent quarter it will not be there. Likewise, in the last quarter, there are various fees which are being collected. So each quarter actually differs. So the better way is to look at the non-interest income is to compare on a YOY basis so that the trends are all captured.
And you mentioned about the capital raising, maybe look at capital raising. Can you give us some color on how much you are looking?
See, as of now, I will share with you, our loan growth is somewhere around 14-15%. But when we look at our ROE, which is at about 19-20%, so actually, on a net basis, it is capital accretive. So long as we have this kind of position, we don't envisage any challenge. But if at all, suppose the loan growth goes beyond what our ROE growth is, then perhaps we'll have to look at it. But nevertheless, we are quite open in terms of this idea. If at all required, we will look at it. And as of now also, if we really reckon the plowback of the profit which we have earned for the 9 months, our capital adequacy ratio stands at about 14.32%. And our CET1 would be 10 point, how much? 10.38. So that is, we are comfortably placed. But yes, of course, as I've said in the past, capital is not going to be a constraint for the growth. And we have already seen that if at all we reckon the plowback of the profit, we can support the 7 trillion worth of loan book growth. Yeah.
Thank you, Ram. The next question is from Richard Pagos of Informers.
Thank you, sir. Sir, can you give us some color on what is the loan pipeline now and what is the capex you are seeing in which sectors which we are?
I would say that we have seen much better utilization when it comes to the corporate loan book. Utilization as well as also the disbursement of the term loan, undisbursed portion has come down. And now actually the way it stands today, we have got a situation where we will have, as far as the pipeline is concerned, it will be somewhere around 4.6 trillion. And out of this 4.6 trillion, it is actually split into the public sector and private sector. Private sector is on the higher side. That is the broad complexion. I would say 75% would be in the private sector and 25% would be in the public sector.
You planning any infra bond? You already done 20,000 crores in first 9 months.
Yeah, we are quite open to this idea, and I think we have now created a book which is perhaps the highest as far as the infrastructure bond is concerned, and we'll be looking for the opportunities, and as and when required, we'll certainly build up this book also.
Just to clarify, SLR holding excess is 4 trillion.
Yeah, as on 31st of December, it is 4 trillion.
Thank you, Richard. The next question is from Ekta Surya of Z.
Good afternoon, sir. So we're seeing a one-time exceptional item of 7,100 crore. If you could shed a bit light on the same.
Yeah, as I mentioned, this is on account of some kind of a anomaly was there in the pension payment to the retirees of the bank. Some people were being paid pension at the rate of 40%, others were being paid pension at the rate of 50%. So there was a court case going on from the year 2002 onwards. Now there is a visibility in terms of we have got some kind of a resolution of this particular outstanding issue, and we have got the approval from Reserve Bank of India also for increasing this pension to 50% for all the retirees, and this liability is essentially on account of that. That is 5,400 crores on account of addressing this anomaly. Though as of now, the Gazette notification has not yet come, and we are required to pay only after the Gazette notification. But nevertheless, since we could see this kind of a liability coming to us, we have already provided for it. 5,400 crore is on account of this pension. The other 1,700 crore is on account of the DA relief for the retirees before 2002. This was something which got resolved. So 1,700 crore is on account of that.
Both of them are one-time. If you could just give me a number for fresh slippages.
Fresh slippages, I think it is 4,900 crore. How much? 4,900?
4,960.
4,960, out of which 900 crore we have already pulled back.
Thank you.
The next question is from Advait Parichu from Bloomberg.
So, just following up on the budget, a lot of commentary has been that this will be a good year for the bond markets. There might be bond inclusion that will happen. What is your outlook on corporate credit pick up from the bond markets, how do you think that will perform? And your yield on investment seems to be flattening. So how do you look at?
I think we have gone up, yield on investment has gone up by about 55 basis points. And also when it comes to the corporate book, which I mentioned, last quarter we had grown in the corporate book only to the extent of about 7%. This quarter we have seen almost about 11% growth in the corporate loan book. So to that extent it's very positive. And when we look at the budget has also given some kind of a reassurance for the continuation of the infrastructure spend, which will certainly open up the opportunities for the corporate borrowing also. And apart from many other things, the newer initiatives which are there in terms of solarization, in terms of renewable power, etc., these are the new growth levers, and we have already started seeing some kind of visibility of such loan proposals also. So I think, to my mind, there is a decent opportunity which will be available.